What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is February 18th of 2022. Well, folks, I hope you are having a fantastic day wherever you are, and in today's video, I want to spend some time to talk about the 7.5% pullback we saw in Bitcoin just yesterday in price, and the nearly 10% correction we've seen since the relative highs. I want to spend some time to talk about what I'm making of it, what I'm doing in the market, and see if I can provide some clarity as to why this might be happening. We've got lots of things to dive into today's video right after our quick sponsor. And our sponsor for today's episode is Ember Fund. Ember Fund is an app that gives everyday people the ability to invest in algorithmic crypto portfolios normally reserved for accredited investors or people with a net worth of over $1 million. For example, their Bitcoin Defense portfolio recently protected investors against the 41% price decline we saw in the last dip. Ember's minimum investment was $500, but now it's only $10, giving anyone access to these sophisticated portfolios. They've also recently gotten rid of gas fees. Click on the link down below in the description to download the Ember app and earn free Bitcoin when you deposit into an Ember portfolio. Alrighty, everyone, let's go ahead and kick things off here. I want to start by taking a look here at the chart for Bitcoin and just getting a bit of a digestion on the price action here. So to put it into context, we pulled back about $4,000 for Bitcoin's price from the 44K range down here to $40,000 just over the past couple of hours earlier on this morning and late last night. Now, I want to go ahead and just put things into context because, again, it can be very easy to be absolutely goosed up, be absolutely fearful when you're looking at the 5-minute chart or the hourly chart. Let's just go ahead. Let's take a look here at the daily. Not too crazy. We've had not only worse days in the past, but outside of that as well, we're still roughly where we were back here at the beginning of February. Not too hectic, right? Pullback of a couple of days for the price action here in regards to Bitcoin's price. Now, at the same time, does this look really good on the chart? Is this exactly what we wanted to see? No. And to be completely candid with you guys, in one of the previous videos, we talked about the fact that we do expect sometime soon that Bitcoin is going to have a pretty significant rally here. All the while, the technical setup was looking pretty good yesterday. It looks like it's probably going to be a couple more days to a week here. And Bitcoin has a very important task on its hand to hold the 40K range. A range we've been talking about here on the channel for the past couple videos. This idea that we need to take previous support and previous resistance in the past and turn it yet again into support for price to move higher, signifying on the broader time frames higher lows and higher highs. Now, one thing that's important to note, all the while, I don't want to overanalyze things. It is important to note that technically we have set in a new short-term lower low here. So as we're around this contestment range here, it's a very important range of price to see whether or not Bitcoin's going to come back down into this infamous $30,000 to $35,000 range, the same range we saw back here during May through July. Or we're going to hold this range and start to charter up higher. Now, my answer, or more specifically, my focus point in today's video is going to be trying to answer what is more likely and also why one of those outcomes are more likely. So without further ado, let's go ahead and kick off into it. So what's dragging down Bitcoin's price here in regards to the market? Well, first off, guys, let's just go ahead and accept that even though there are definitely some headline reasons that we will be talking about, it is a matter of people selling their Bitcoin on the market, on the spot market. And it doesn't always have to do with the headlines, the news events. It can be people doing short-term trades or whales playing their games and driving price one way or the other. But I want to go ahead and focus in on what's been going on in the traditional equity markets. Now, you all know if you've been long-term viewers of the channel here, I traditionally came from a background in equities, traded equities markets over the past 10 years. And for me, it was where I got my foothold when it came to investing. And many of you out there probably invest in equities as well. But for those who aren't tracking the equity markets or the stock market, to put it simple, right now, we're seeing a pretty fearful period of time here for equity markets. You've got a mixture of generally two macro events. You've got people concerned that the Federal Reserve is going to start cutting back not only its lowering of interest rates, so basically hiking interest rates, making the cost or the base cost of capital more expensive. You also have concerns that not only that is going to start in March, but that eventually the Fed at the FOMC meeting is going to announce that it's going to start quantitative tightening, aka reducing its balance sheet, reducing the amount of money in circulation, and therefore the amount of credit in the system, which of course is not beneficial for assets. And then finally, you've got the macro fear that there's this conflict between the US or NATO against Russia over Ukraine. And these two things have obviously played a role in spooking the markets a bit. And we can see here, since back here, and we're taking a look at the NASDAQ, for example, or the IXIC, right? We can see here that we've gone from around 16,200 all the way down here to 13,716. And whatever recovery we were having here from the later part of January to the opening of the month in February is appearing to look like a dead cat bounce that's going to roll over and continue lower. And I'll be honest with you guys, I got to be completely candid. All the while, I would feel comfortable starting to buy equities in this kind of discount range as it's over the 10% mark, which again, for kind of mid-cycle corrections that are on the cusp of being labeled the 20% bear markets, that's generally where I like to buy dips. But the further we go down, that's more of an opportunity in my mind. But we can clearly see here that ever since here in November of 2021, since we've been pulling back, there has been a pretty dramatic correlation here with the drag down in equities and the drag down in crypto, right? And there's a big reason for this because of twofold reasons. One, crypto as a market is getting larger, and therefore it will probably play very similar to equity markets as it continues to grow as an asset class. It's not 100% confident, but it's a thing to keep in mind and to probably accept as a reality here, as it used to be this kind of niche asset class that was diverged away from equities. Now, at the same time, it's important to understand that asset markets as a whole benefit similarly from Fed monetary policy. And on top of that, when the Fed takes the other direction, when they're not stimulating markets, right, and putting new money into the system, on the other end, when they start quantitative tightening, they start reducing the balance sheet, they start rising interest rates, that could possibly harm crypto markets just like it does equities. But the big thing I want to drive here is that all that we're seeing right now in regards to price, excuse me, what we're seeing here in regards to price so far has been all around fears of the talk of the Federal Reserve. And along with that as well, around the conflict in Ukraine. Now, I don't want to be too opinionated, guys, whether it's on Fed monetary policy or the Ukrainian conflict. I know everyone in their grandma has got an opinion on these types of things. But I want to try to give as much of a sober perspective as I can without thinking about my personal opinions or anything of the likes, okay? So let's just go ahead and first take a look at the reality here. Russian NATO conflict over Ukraine has been a lot of talk over the past couple years, right? And it's important to note, we talked about this in the Dash Report discussion group webinar we just recently did. If you take a look back over history, the NASDAQ or any other type of market index, what you'll find is a really interesting trend where time and time again there are spook stories. There are things that scare the market. You had the flash crash back here in 2011 where algo traders were just dumping into the market, selling loads of shares. You had, for example, the Chinese commodity crisis back here in 2015. I remember trading this and losing a heck of a lot of money in this case because I was toying around with leverage. Learned that one the hard way. And at that time as well, the Shanghai Composite as well in China was blowing off of a bubble top. And everyone was concerned, is this the final bear market? Is this where we get a 50% drawdown? No, it's not what we got. We got a typical, I think, 15-20% correction in the value of equities. Then we had the scare here when the Fed started to rise interest rates and started to reduce its balance sheet. And people were worried that that would drag down equity markets. And then the Fed reversed things and all was well. And then we had the COVID scare. And of course, as the Fed injected liquidity, prices started to skyrocket higher and there was rampant speculation. And now we've got our new spook story. In fact, we've got two spook stories that the Fed has miraculously promised, as it's done many times in the past, that it's going to start to reduce its balance sheet and it's going to start to try to curb inflation. Well, I've got news for you guys. The Federal Reserve talks a lot and does another thing when it comes time to equities facing the pain. When assets start to face the pain, the Fed reverses course. Now, I understand some of you might say, and this is an important point, I think it's a very fair kind of criticism to maybe the opinion I'm sharing, right? Whether it's the Ukrainian conflict or what's going on in the equity markets in regards to the Fed, you might be saying, Nick, it's different this time. Inflation is getting to crippling levels. The Fed's got to do something, right? And they're going to try to make dramatic action to try to take down inflation. Right? It seems like that, at least the way they're talking. But I want to go ahead and put you guys to a really interesting chart here in regards to historical inflation and the curve of inflation we've seen here. Econometrics put out a really good chart, and this is something that I've been driving hectically as a point here that needs to be considered here. That rolling annualized inflation at either high single digit or double digit levels not only will last much longer than many people think before the Fed will do something, but on top of that as well, it can have multiple phases and waves that get higher and higher over time. Just like a chart, higher lows and higher highs. It's indicative of an uptrend, right? Now, I'm not a big fan of inflation. I would love to see the Fed do the right thing, spike interest rates, get loans towards productive activities in the economy, start to reduce its balance sheet. I don't care. I'm not trying to sit here and defend my portfolio. I don't care about that. But I do know that the Fed likes to say something and do another. And take a look here from January 1972, mapped over the same time from here, starting back when the Fed started to inject money into the economy. Inflation started to pick up here in January 2020. We are likely just getting started here, folks. Now, we might be coming up on the end of the first wave here of inflation. Maybe the Fed does a little bit to try to curb it. But I can guarantee you all, if we're going off of history here, the Federal Reserve is likely not going to take any serious action. They are not going to pull a Paul Volcker until much later than people think. And what I mean by Paul Volcker is basically spiking interest rates, really hampering down the economy, and knowingly accepting that you're probably going to be stepping into a recession. This can happen multiple months later than people think, right? This is dozens upon dozens of months here as we went through the decade of the 70s, right? So again, really important thing to keep in mind here. Really, really important stuff, guys. Inflation can remain heightened for a long period of time. And I think people sometimes lose sight of that. Not to mention as well, one thing I do want to talk about here in regards to the equity markets and what's really dragging down equity markets at the moment, really making up a lot of the valuation decline here that's brought us back to where we were in June of 2021, right? More than half a year's of gains worth of equity value wiped out here. What's really happening? Well, if we take a look at the NASDAQ's big tech companies, the FANG stocks, and a variety of other stocks that benefited during the wave of COVID have now started to take massive hits. We see Facebook or Meta Platforms down for its worst month on record. Take a look at this here, guys. 33.6%, the worst month since back here during the IPO sell-off for Facebook when it was first listed, right? Now, to put it in a logarithmic perspective, right, still is pretty chilling here, knocking it down to values that haven't been seen since July of 2018 and January 2020. Major gains wiped off for Facebook here. Take a look at Netflix, same exact story here, right? Topping at around $690 per share. Nice. Down to $386 at the moment, right? Take a look at the monthly candle here. Not looking very pretty here and looking like we might be setting up for a pretty stagnant correction here and probably an overdue one for Netflix as it had chilling growth numbers in its recent earnings report. Take a look at Google here, right? Google faring a little bit better here, but still looking like it's rolling over here. Any rebound we saw picking up Google stock has now started to fade back over, looking like it might be getting its first significant correction in a long period of time, really since the COVID rally. Take a look at Microsoft here, right? This is a really interesting chart here. Microsoft has had two decade-long rallies here in its equity price that really signified the growth of the stock, and other than that, it's generally stagnant periods. Well, we can see here that we might be getting our first major rollover here for Microsoft on the much longer term trend. You've got PayPal, which even in the logarithmic chart just looks abysmal. If you take it off the log, it looks even scarier here, completely wiping down any benefits it had had during this period of time of excessive digitization, people picking up digital payments, right, structural readjustments, all these things. PayPal's all the way back down to $105 per share. If you divide it by the M2 or money supply, that's looking like an absolute catastrophe. Let's take a look here at Zoom, right? Zoom here, we've been watching for a discount here to come down to this range. But boy, just since back here in August, down another 69%. If you take it from the absolute highs, it's about more than 80% correction here for Zoom. Not looking good. Amazon holding up a little bit better, and Apple Still, those two tech companies kind of holding out as the shining examples on a hill that we might still have some steam in the market. But things aren't looking very good in the tech sector. And that may not bode well for crypto in the long term if these stocks don't start to really make a rebound upward. The one area of the equity markets, though, that's been more neutral, hasn't been exponential over the past couple months, but also hasn't been giving up too much gains, are indices like the Dow Jones and the S&P 500. Dow Jones has been pretty flat here since April 2021. It's not seeing the kind of panic that the rest of the market's seeing, but at the same time, it's not seeing as exponential of growth. So it's really interesting to see here that we're really seeing a lot of the fluff in the tech sector, this kind of everything bubble that's been going on for a long period of time. And we've had price to earnings ratios that are just out the wazoo, right? Valuations just not making sense anymore. Companies that are nowhere near profitability, trading for billions upon billions of dollars in market cap, right? All this craziness going on. But I want to go ahead and take it back here, now that we've got this good context here, and talk about what it means for crypto. I know you guys are probably thinking, Nick, you've rambled on long enough. Tell me what it means here for Bitcoin's price. What I think this generally means, and more importantly, is that the market, yet again, is going through another fear spell in equity markets. If we continue to see this roll over here in regards to the NASDAQ, for example, I think what's likely that you're going to see, let me get, I have it here on the QQQ chart. There we go. I think what's likely is that we're going to have a quote unquote bear market for equities, 20% correction across the board. And that could either be right here around the $320 range on the NASDAQ, bringing us back here to May of 2021 or March of 2021, cutting down about half of the gains here, right? This COVID rally, or coming down here to a 26% correction down to this support range and previous resistance range in price, right around at about $300 on the QQQ, coming from originally around $400. Now, considering that either of those scenarios here, playing into the fear on the Ukraine scenario, playing into the fear of the Fed and tightening monetary policy, this obviously has everyone spooked, and it will probably continue to spook people. I think what's very likely here is that we've got a chance. We've really got a chance here. As much as I'll say it more than I think most people will, that we might have gotten it wrong here and prices might roll back down to this range. I think that's the worst case scenario here for crypto, that we come back down to this consolidation range, kind of like what we did back here, even though we had a more heightened breakout here in prices. But I'm going to go ahead and make something very clear here, guys. Really, no matter whether or not we get that pullback down to the 30K range or the kind of $30,000, $35,000 range, or if I'm wrong on that in that case and we just continue to break out here and we see an imminent rally in the market, no matter how it plays out, this is not some kind of reason to go out and sell all your crypto. And I think that's the thing that, of course, is on everyone's mind. It's been on the minds of many people because there just hasn't been that kind of surge. I think we got a little bit spoiled. We got sugar-coated from the January 2021 rally going into March and April where Dogecoin was going to the moon. Everything was going up. Everything was so exciting and grand and awesome. Nothing could go wrong. Crypto was in the spotlight. And now everyone is worried, oh my gosh, the Fed's saying all these things. There's geopolitical conflicts. Equity markets are pulling back. This is a time where I got to be concerned. When in reality, if we take a look, and again, another great chart here, I just happened to find here from eCoin Metrics that I wanted to give full context and credit to. It's this really interesting chart here from the previous Bitcoin corrections in the past, right? This is the range of drawdowns for Bitcoin here. And you can see here, there are really only two major corrections we've had here in regards to Bitcoin that really line up. Obviously, the previous one we saw back starting in May that pulled down prices and we started to recover afterwards, right? We can see this is the existing one we've got right here. And of course, one of the longer term rally sell-offs back in the past here for Bitcoin. Back, I think it was the 2013 correction. So again, just take a look at this chart. I'll go quiet for a sec. Let me know what your thoughts are when you watch this. I got to tell you all, I'm not rushing to sell my crypto when I look at something like that, right? Now, of course, everyone can give you different perspectives, but one of the best things you can do is history analysis, historical analysis when it comes to crypto, and see whether or not, we're at a typical drawdown range where it's time to still look for more downside, or are we at a potential buy opportunity? Or are we at a potential maybe just holding out period, right? You got the three different sentiments. You've got kind of buying, selling, and sometimes just holding it out, waiting, not doing anything, not panicking, whether it be panic buying or panic selling, right? And definitely not trading with leverage or doing silly stuff when the market is really inconsistent like this. Sometimes it's best to just hold it out, give it some time, and most importantly, set your expectations to be level-headed, right? Now, I want to make something very clear here as well, guys. And again, I try to keep this fine balance and stuff here on the channel and stuff, talking about my expectations for things. And I want to make it very clear with like the language we use here on the channel, because everyone interprets things different. Everyone's got different perspectives on how they interpret what someone says and what they, what they're doing in the market and stuff, and they focus on different things. My biggest point I want to drive to you guys is to follow the general chart here. We believe that by some time here going into the spring, going into April and May, that's when we could start to revisit the all-time highs. It might be that we continue to chop here sideways for a little while and we play catch up in the near term, right? But again, when we talk about here the idea that we could see a breakout, we're focusing on going into the next preceding weeks and months. We believe that Bitcoin is going to have that setup where it can start to charter higher. But at the same time, it might take a little bit longer than we predicted here. We're not perfect here at DataDash. So just want to make that very clear to you guys. If you guys want to know what my actions are, and I think that's probably what matters most. Unfortunately, a lot of content creators don't talk about it enough. I haven't changed a thing. Haven't sold or bought anything in the past couple days. Just kind of waiting, seeing what's happening. And if we get another dip opportunity, and if I have fiat on hand, I'll probably buy in at that same range we went to, around the $33,000 price range. If we get anything near that, I would probably be buying it, because historically speaking, that's a range where buyers are coming in. And the bulls on the longer term time frames we talked about have been buying at consistently higher lows over time. Right? They're not waiting around for prices to come back down to where they were here in January. They didn't wait around for it to come to the 29, 30K range like we saw for May and July. They came in here at 33,000. That's when the market order flow took back control in favor of the bulls. And you got to take that time to look at the long-term time frame to see whether or not the bulls are still in charge or whether or not the bears are in charge. It's in tango right now. And we're going to have to see which side comes out victorious. But I got to tell you all, I really am not afraid of the Fed, not really afraid of the global conflicts. There's been tons of these going on. And it's more than anything, it's just sad. Like, it's typical geopolitics at the end of the day. It's the one opinion I share and stuff from studying foreign policy. It's poking either side and stuff to get more power, more resources. And for me, honestly, I just like to stay out of it for the most part and look for greener pastures in the future. It's gotten me to where I am today. And I think it's a mindset that all of us could benefit from, especially during these turbulent times. Anyways, I know I kind of rambled, a little bit misorganized in the video, but I hope there was some good substance here for you guys, that you like the content. If you enjoyed it, please drop a like. If you have any feedback or thoughts on what we talked about here, please feel free to leave it down below in the comments, whether you agree or disagree. I want to hear from you guys down below in the comments, a good discussion going. But until the next video, guys, stay safe, trade smart, and I'll see you all in the next one. Take care, everyone.